If you're keeping too much money sitting in your bank account right now, you might actually be making a huge mistake. I know that sounds crazy because for most of us, having extra cash feels safe. It feels responsible. But here's the thing, that safe feeling might actually be slowing down your financial growth. According to CNBC, 82% of Americans don't even use a high yield savings account, and 57% just keep their money in a regular savings account that earns almost nothing. Cash management is one of those underrated skills in personal finance that nobody really talks about, but it can make a massive difference in your long-term wealth. So today I'm going to break down why holding too much cash could actually be one of the most expensive mistakes you're making with your money, and more importantly, how you can fix it. Reason number one, inflation and the erosion of purchasing power. Have you ever noticed how hard it feels to move money out of your checking account? Even when you know it's just sitting there doing nothing, it still feels like you're losing something when you move it. But that's not a money problem. It's a mindset problem. Our brains are wired to see cash as safety. When you can see it sitting in your bank app, it feels like security. But the moment you move it into an investment, even though it's still your money, your brain says, wait, am I losing this? That's why so many people hold on to cash for too long. Yeah, it feels safe, but it's not. While that money sits there, it's quietly losing value every single day. Let's say you have $50,000 in a savings account earning 0.5% interest while inflation is around 3%. That means your safe $50,000 is actually losing about $1,250 in buying power every year. You're not being careful. You're paying a hidden tax for comfort. This is where most people get stuck. Every time they think about investing or moving that money somewhere better, it feels risky. But you're not losing money. You're just giving it a job. Keeping all your cash in the bank is like leaving your car parked because you're scared to drive it. Sure, it won't get a scratch, but it also won't take you anywhere. Now let's talk about another big reason people keep too much money in the bank. The emergency fund trap. Having an emergency fund is important. Everyone needs one. It's your financial safety net. But the problem is, most people take it too far. You start off right, saving 3 to 6 months of expenses. That's perfect. But over time, that safety net becomes a comfort zone. You keep adding more just in case. 10,000 becomes 20, 20 becomes 50, and soon half your savings are sitting there doing nothing. At that point, it's not an emergency fund anymore. It's financial paralysis. The goal of an emergency fund is protection, not perfection. You just need enough to handle short-term problems like a job loss, a car repair, or a medical bill. Anything beyond that is just money collecting dust while inflation eats it away. Let's say your monthly expenses are $4,000. A healthy emergency fund would be between $12,000 and $24,000. But a lot of people keep $60,000 or even $100,000 sitting in a low interest savings account because they think it's safer. The truth is that extra $50,000 sitting in a 0.5% account while inflation is 4 or 5% is losing more than $2,000 in buying power every year. That's money disappearing just because it feels safe to see that number in your bank app. The irony is the fund meant to protect you from emergencies ends up creating one. Your money slowly losing value. Real emergencies don't happen every week. That money might sit untouched for years, and during that time, it could have been working for you, like in a high-yield savings account, a money market fund, or a simple investment that keeps up with inflation. But the word emergency makes people afraid. It makes you think, I can't touch that money. And that fear keeps you stuck, trapped in the belief that more cash means more safety when really it just means more stagnation. Reason number 3, you feel like spending more. Here's one that hits close to home. When you see a lot of money sitting in your bank account, you start to feel rich, and that's exactly when the unnecessary spending starts. You open your banking app, see a big number, and think, maybe I can upgrade my car, or I deserve that weekend trip to Miami. And just like that, your brain switches from saver mode to spender mode. It's not your fault, it's how the brain works. Behavioral economists call it the wealth effect. It means that when we see more money, we feel wealthier, even if nothing about our financial situation has changed. And when we feel wealthier, we start to spend more, often on things we don't really need. It doesn't happen all at once. It creeps in slowly. You start eating out a little more. You buy the newest phone, even though your current one works fine. You tell yourself it's just a small treat because, hey, the balance still looks good. But those little choices add up fast. That's how people end up saving less when they actually have more. When your money is sitting there in plain sight, it feels like it's begging to be spent. Here's a simple trick that financially disciplined people use. They hide the temptation. They only keep what they need for bills and short-term spending in their checking account. The rest goes somewhere else, like a high-yield savings account or an investment account. When you can't see the extra money, you're less likely to spend it emotionally. It's not gone, it's just protected from impulse. Having a big balance in your checking account is like keeping junk food on your desk when you're trying to eat healthy. You can promise yourself you won't touch it, but sooner or later, you will. That's the danger of keeping too much money in the bank. It doesn't just lose value, it tempts you to lose control. It quietly turns your savings into spending fuel. Reason number 4, you become more of a target. This next one doesn't get talked about enough. When you keep a large amount of money sitting in the bank, you're not just missing out on growth, you're also making yourself a target. And I'm not talking about spam emails or random phishing texts. I'm talking about scams powered by AI, scams so realistic that even careful, smart people are falling for them. There was a man named Anthony from Los Angeles. One afternoon, he got a call and heard his son's voice on the other end. The voice sounded panicked. It said he had been in a car accident, he was in jail, and he needed bail money right away. Naturally, Anthony panicked and wired $25,000 immediately, but it wasn't his son. It was a scammer using AI voice cloning to copy his son's exact tone and speech. Anthony lost $25,000 in a single phone call. The scary part is that scammers don't go after random people anymore. They target people who look financially stable, people with big bank balances who can move money quickly without thinking twice. The more cash you keep sitting in your account, the more appealing you look. From the outside, your digital footprint says, this person's doing well. They can afford it. They'll act fast if it sounds urgent. That's all scammers need. One moment of panic, one fake call that sounds real, and they're in. When you keep too much money in your account, you're not only risking inflation or missed opportunities, you're also risking becoming a target in a world where technology can fake almost anything. Reason number 5, your money isn't fully protected. Now let's talk about the final reason. And honestly, this one's the scariest. If your bank ever fails, your money might not be as safe as you think. Most people assume, it's fine, my deposits are insured. And yes, that's true, but only up to a certain limit. Beyond that, your cash isn't automatically protected. If you think banks don't fail anymore, remember what happened with Silicon Valley Bank in 2023. It was one of the biggest collapses in US history, over $200 billion in assets. Thousands of people suddenly couldn't access their money. Many had way more than the insured limit sitting in their accounts, and for a few tense days, no one knew if they'd ever get that money back. The government eventually stepped in, but that's not something you can count on every time. And it's not just about bank failures. Like even a simple system glitch, a cyber attack, or a freeze on your account can lock you out if all your money is sitting in one place. That's when you realize your safe balance isn't really that safe. The simple rule is this: know your limits and spread your risk. If you have a large balance, don't park it all in one account. Diversify across banks or move some into safe, liquid investments that still give you. By now, you can see the bigger picture. Keeping too much money in the bank doesn't protect you. It holds you back. Your bank account isn't a vault, it's a pipeline. Money should flow through it, not live there. You only need 2 types of cash: the money you'll spend soon and a cushion for emergencies. That's it. If you like this one, drop a like, share it with a friend, and don't forget to subscribe.